Happy Friday, everyone, and welcome back to Open Exchange TV. I know you all missed me last Friday. It was very sad. Poor old Jay Pelosky couldn't join us for the day, but he's back this week as we have month end and quarter end. Welcome back, Jay.
Scott, it's great to be back, but I have to ask you, my friend, why are you still struggling to get your camera and chair placement correct?
Well, you see, when I get a haircut, I've got to readjust everything, and we had a haircut last week, so that's why we're here today and moving a camera around and so forth. But we're good. I'm not here to talk about me, though, Jay. We're here to talk to you about your monthly, the extrapolation and beyond. Obviously, a very long word, and you're going to have to explain all this to the viewers why you have the title for your musings like that this week.
Well, I mean, it's just been a wild ride, right? The last couple of weeks, the last month, the last quarter, year to date. And, we've dealt with unprecedented volatility in fixed income markets, gyrating foreign exchange markets, equities taking it on the chin. And all of it seems to come back to extrapolation, right? So investors have been extrapolating all sorts of trends over the last couple of months, whether it's inflation, central banks' response, King Dollar's rise, more recently, the UK tempest in a teapot, as I called it the other night on Bloomberg, which actually seems to have been accurate since the pound and gilts are back to levels that preceded the mini budget here just 3 or 4 days later, or extrapolating the weak economic data into recession. That's been all the rage. It's been all about extrapolation. And by the way, it's made sense because it's pretty much been the right thing to do, right? The question on the table, Scott, is it going to continue to be the right thing to do? And we argue in this monthly, supported by 25 different charts and tables from multiple people in the investment community, is that it will not be the right thing to do. Investors should not extrapolate the current trends into the future, because we believe we're near a trend break in many of them. And of course, it's going to start with the inflation in the US, with the Fed, with the dollar. All those things are interlinked. And in the interim, while we wait for that to happen, you have equity markets and risk assets at close to record cheap levels, particularly outside the United States. You have sentiment being pretty much the worst it's ever been. You have positioning pretty much the lightest it's ever been, and you have risk appetite among the lowest it's ever been. And so, to me, an awful lot has been priced in, and we believe that bottoms are a process, not a date, not a level, a process. And we're in that process. And so we're sticking to our high nominal growth rate environment, which we believe will again prove supportive of earnings in Q3 and beyond, as it did in Qs 1 and 2. And therefore, we're holding firm to our convictions.
That's great. I love how you're having that confidence, because there's a lot of people who aren't. And like, listen, we've had
really. No, are you serious? There are people who aren't positive. Come on, I'm pretty much the card-carrying member. They joke with me on Bloomberg as what did John Farrell say last time, or one of the last times I was on? 1-800 call Pelosky for an optimistic point of view. I mean, don't worry, Scott. I'm aware that I'm in a minority. My wife even tells me I'm in a minority. My kids. I don't have a dog, but if I had a dog, they'd tell me I'm in the minority. So I get that. And I'm okay with it. I'm not offended.
Listen, we always like to have positive people, and it's great to have you running us down through all of this. But what I want to get into now is, because it's your monthly, you have this great theme. You go through like the global risk nexus. So let's move into that part of it now. Let's start on the climate side of it and how you broke that down this month.
Well, it's interesting, right? I was down at Duke last week, why I was not with the folks on Open Exchange, and met with a bunch of people, including one friend of mine who's a venture capitalist in the energy space. And I asked him, how's it going? And he said, dude, it's gold rush time. And I said, gold rush time? Because, the public market stuff, climate related, has been hammered over the last couple of weeks. And he said, yes, in the VC space, after the passage of the U.S. Inflation Reduction Act, which had $370 billion in climate funding over the next decade, which McKinsey thinks will be levered by $1 trillion of additional private money. These guys think it's gold rush time for clean energy, climate-related investing in the United States. And one of the things that I've been reading about is kind of this nexus between the public and the private, exactly what my friend was talking about. And a recent example, just literally pulled from the headlines over the last couple of days, is a two-point example along the electric vehicle and charging issue, right? So we separate climate into two big buckets. One for carbon reduction. One is transportation. The other is power generation. So on that transportation side, we're in the middle, early innings, not middle, very early innings of an electric vehicle revolution. And so Hertz just committed to buying 300,000 electric vehicles over the next year or two, and has partnered with BP, British Petroleum, to set up a nationwide charging system across the United States. That is going to be alongside the U.S. Department of Transportation's commitment to spend $5 billion over the next 5 years, $1 billion a year, to establish a nationwide charging system throughout the U.S. interstate highway network. And so that's an example of exactly what we're talking about. Private sector money, public sector money coming together to basically establish a nationwide charging system across the United States to absorb all the electric vehicles that are going to be sold over the next 1, 3, 5, and 10 years. And we have a great chart in the monthly showing the hockey stick of electric vehicle adoption globally, as well as in the United States. And so that's really the story in the climate space, Scott, is we're starting to really see public and private kind of co-investing to deal with the issues of climate change.
Okay, well then let's move on to the economics side of it as well then. We obviously missed you last Friday, as we mentioned earlier, but the UK shook up the markets and we didn't get a chance to talk about it. So I'd like you to touch on that quickly.
Sure.
But then also look at China or Japan, who apparently aren't worried about that word inflation.
Yes. Well, that's part of that. I mean, you have done your homework. You have read the executive summary. I'm very impressed by that. You get an A+, my friend. I hope my kid gets an A+. He's got a Latin test today. He better get an A+, or it's going to be tough for him. So economics, yes. We do have a desynchronized world. I think that's really important for investors to remember, right? We get all these headlines about, global central banks raising rates, and they make it seem like it's, you see charts with the number of central bank hikes. The important thing is that of the 4 major central banks in the world, Fed, ECB, Bank of Japan, Bank of China, PBOC, Bank of China, 2 are raising, ECB and Fed. 1 is standing pat, Bank of Japan, and 1 is cutting, PBOC. And that's very different from an idea that all central banks are hiking all around the world. We have a desynchronized monetary policy mix, and I think that's important. But really the issue, of course, is inflation, right? And inflation has constantly surprised to the upside, disappointing consensus, worsened consensus, et cetera. I note, though, that people have absorbed this, right? This is the point. We've extrapolated all this stuff. So today, the EU reports its September inflation reading. It was 10%, a shocking number, double-digit number. What did the euro do? What did rates do in Europe? What did equities do in Europe? Equities rose, rates fell, euro stable. Suggests that it's pretty much in the price. And so I believe we're coming up to a point where we're going to see inflation roll over in the US. I have said that before. I admit it. I have been wrong. But I think the weight of evidence, including now even rents in the US, pretty clear evidence from Zillow, from Realtor.com, from CoreLogic pricing surveys, pretty convincing weight of evidence that rents have peaked in the United States and are starting to roll over. And that's key, obviously, for the sticky parts of inflation, housing, and labor. We'll get more insight into the labor market in a week or so, right, with the job numbers. But I'm pretty confident that in the coming months, we'll see lower inflation levels, and that is going to be very supportive for a Fed and a possible Fed pause, given that they have been aggressive. We now have rates at 3.5%. We have a terminal rate of 4.5%. And if inflation starts to ebb, that I think is going to give the Fed an opportunity to say, hey, let's just slow it back a little bit. Let's see, we know our tightening operates with a lag. Let's kind of observe here and see where we go from there. And when that starts to percolate into the equity market, things are going to look very, very different in my view. Europe has a different issue. Obviously, they have a big energy problem, but even there too, the headline was 10%, but core was less than 5, I think 4.8%. And so I believe actually that the ECB is probably going to raise rates more in the next 6 months than the Fed. And that should be supportive of the euro and bad for the dollar. So again, another extrapolation, king dollar. That's all you hear about. Okay, I think that's about to change as well. And then finally, you noted Asia. One, Asia doesn't have an inflation problem. And two, growth is picking up there. So, I mean, the data just today, there was a pretty decent data dump with Japan, retail sales better than expected. Industrial output, better than expected. Housing starts, better than expected. You had China with its PMIs. The headline, China PMIs disappoint. The reality, PMIs, both manufacturing, service, and composite, above 50. Is the US above 50? No. Is Europe above 50? No. Is China? Yes. Again, desynchronized. And I think that's a good thing.
Okay, well, let's move on to politics. And once again, I've had a quick read of the executive summary, but obviously big news in Italy this week with a new leader, new female leader, which I've never had before, very much to the right. But also we've got coming up the US midterm elections. And are they giving you any concern?
I'm not really. I think they may give people a surprise, right? Traditionally, the party in power loses lots of seats in the midterms, right? That's the norm. In this case, that may not happen that way for a couple reasons. One, the abortion ruling by the Supreme Court has gotten people very energized, expect to see a very large turnout, particularly by women. And then secondly, a lot of the Republican candidates, particularly the MAGA candidates, are really not fit for purpose. I guess some people would argue that, but a dispassionate observer probably wouldn't. And so a lot of those candidates are not going to win. And so that may be a surprise. Also in the Americas, keeping in mind our tripolar world, Brazil is going to the polls this weekend. And the former president Lula is leading and is expected to beat the incumbent, Bolsonaro. There is question about whether President Bolsonaro will accept a losing result. He's kind of like Trump in that way. I expect him to accept the result. And if it doesn't, you need a majority to win in the first round. The second round is at the end of the month. So within the month, we'll have new leadership, I imagine, in Brazil. You mentioned Italy. I think the important point there is that the Italy is very dependent on significant EU funding over the next couple of years through the Next Gen project and the Fit for 55 project on clean energy. Very dependent. So The new leader has already noted that she plans to govern as a moderate, and I think that's likely to be the case. Again, you can watch the spread between Italian debt and German debt. That tends to give you a sense of where the risk appetite is. With her election, it widened out a little bit, but not dramatically, and nothing like past periods of big worry. Years ago with Brexit and Salvini, that spread blew out, I think, 400 or 500 basis points. Today, it's a couple hundred basis points. And then finally, and importantly, China has its People's Party Congress, which occurs once every 5 years in mid-October. And here, President Xi is likely to get his third term, which is unprecedented, and establish him as the main person in China for the next 5 years. We're watching not so much that part of it, as much as we're watching to see who fills out the 9-person Politburo, which is the real guiding group for China and for the Communist Party and for the government writ large. There will be a number of changes, and we're watching particularly on the economic front, because China needs, notwithstanding its PMIs above 50, China needs to really focus in on growing its economy, particularly its domestic demand, which comes out of the property bust, which we've talked about many times in the past.
Okay, well, let's move on to the policy front. Obviously, there's many, many different countries going through this side of it. As we've seen the markets move aggressively in the US at different stages this week too, with different rumors. Talk to us about your thoughts on the policy front.
Well, I mentioned the UK, and you talked about it. I called in on Bloomberg Wednesday night, a tempest in a teapot. They practically gagged, laughing at me. But I think that's actually proven to be the case, right? The Bank of England stepped in, said they would buy bonds, and what happened? 2 days, 3 days later, today, Friday, the pound is back to levels that it was at pre the mini budget. Gilts are back to levels pre-mini budget. And I think importantly, whatever happens with sterling, I mean, our view, given our tripolar worldview of regional integration in Europe, Asia, and the Americas, that the UK kind of sealed its fate with Brexit, right? 6 years ago, 2016. Now it's just a small island nation that has kind of divorced itself from a $17 trillion economy that is the EU, and it's got to find its way. And it's really made no progress over the last 6 years. You've had all the Boris Johnson kind of, comedy show, no real action to improve its competitiveness. So sterling has weakened and probably will continue to weaken because it needs to cheapen itself to have a chance in the global economy as a small island nation going it alone. However, I do think it's important to understand that the tension between fiscal spending, right, tax cuts, spend money, and monetary tightening, Bank of England raising rates to bring down inflation, that tension is going to somewhat be in place, I think, globally for the next several years. Reason being, governments have understood that they need to spend money to protect their citizens from what we call the 3 Cs: COVID, climate, and conflict. In the European case and in the UK case, the energy crisis. And so this is one of the reasons, Scott, why we think we're in a high nominal growth world. And growth is going to be better than expected over the next couple of years, more so than people think, because governments are going to spend money. And yes, you will have a tension because rates are no longer negative or 1%, right? Rates are now 3 to 4%. But in a decent growth environment, you can absorb those rates, particularly if inflation comes down because productivity goes up. This was what happened in the mid-90s. You know, that's our analog. We've talked about it here on Open Exchange many times. Our analog for the next 3 to 5 years is the US 1995 to 1999. CapEx boom, productivity surge, great stock market performance. We think that stock market performance in this case will be outside the US because the US is so much more expensive than the rest of the world. But that's really what we're looking for. And it comes from the fact that governments have recognized post '08 that they need to spend money to protect their citizens. And they're going to do that. And the UK is an extreme example. But I think that tension is something that for us brings out a broader, more important point, namely public-private partnership, like we talked about with the Department of Transportation and Hertz, going forward to deal with climate, conflict, COVID, energy security, and that supports growth, capex boom, earnings, and that's why we're constructive on the medium and long term for risk assets.
Okay, as we always wrap up these like little things, it's like we get to the wonderful part of markets, and wow, what a week we've been having with some volatility here. And even speaking now, like the market looked like it was going to continue rallying up into the end of the day, but like here we are, it's selling off now.
Yeah, I mean, I'm just happy I'm not a trader, right? Because I mean, I just can't imagine trying to trade these markets, whatever you trade, whether it's rates or bond or currencies or equities. I mean, it's just been really just wild, wild swings. And so we put a chart in the monthly from Invesco talking about how it's not a loss until you sell it, right? Because the chart is great. It goes back a long period of time, shows the spread of returns on a yearly basis, right? Peak drawdown and median return. And so, you know, markets tend to have drawdowns during the course of the year. Obviously, the year we're in now is quite an extreme example of that. But nonetheless, you tend to have drawdowns pretty much every year. The question is, they're not actually, until you take the loss, you know, it's not actually a loss because the market tends to end up on average, as we know, 7 or 8% in the US going back, you know, pretty much the last 100 years. So that was the first chart in our market section this month. It's not a loss until you take it. As we talked about at the open, right? You know, valuations are at an extreme. The rest, ACWI US, for example, trades at 11 times forward earnings versus the US about 17 or 18 times. That gap is about double the gap that has existed between the two, because the US has been expensive for a long time, for a decade or more, but the current gap is nearly twice as wide as the average over the last decade. So US clearly very, very expensive. Rest of the world clearly very inexpensive. Brazil, for example, trades at 6 times forward earnings. 6 times forward earnings. That's very cheap even for Brazil. And yes, they have very high short-term rates. That's one of the reasons why your PE is so low in Brazil. But to me, there's a real opportunity brewing, we believe, in the emerging market space. And we've talked about that. We've been adding to EM, both debt and equity. Within the debt market, we continue to prefer credit, as we talked about, as well as emerging market debt. We've been very bearish bonds. Remember, we were talking about a secular bear market in bonds last year. It's come to pass. We've been in credit. Credit doesn't show any sign of a real distress, importantly, for the people uber bearish. No real signs of credit distress because leverage is very low in the corporate sector, low in the housing sector, and both housing and corporates and banks are flush with money. So we don't see the systemic risk coming from the credit side. And we feel like we're getting paid with 9% yields in the high yield space. We feel like we're getting paid to take risk. So our view basically is we're staying long equities. We're long non-US equities. Within the US, we're long value and small caps. Financials very cheap. US financials selling under 1-time book. That rarely happens. Less than 1-time book, 10 times earnings versus 17 or 18 for the broader market. Energy is flat on its back. It's rarely been cheaper, the big oil majors, yet they're printing money. They have a 4% dividend yield. And if you look at oil inventories, they're at near record lows on a global basis. So we continue to hold those two sectors. long non-US. We talked about Europe. We talked about emerging markets, Brazil, one of our favorites in EM space. We're long EM debt. We're very underweight sovereigns. At these levels, starting to maybe get a little interested in US treasuries, but the volatility and the illiquidity is too much for us at this point. And so we're still staying underweight there. We continue to believe in the secular bull case for commodities. And so we remain long commodities. And we really are focused very much and have been on the dollar, right? Our feeling is that the whole thing is inflation, Fed response, dollar strength. That's been the driving issue, right? Rates rise, dollar strong, and everything falls to the wayside. We think the dollar is about to roll over when the Fed ends its front loading. We think that was probably in September, a couple weeks ago. Remember, the Fed doesn't meet again for another 6 weeks. So we think in the interim, the data is going to start to come in that suggests the Fed can move to 50 basis points. When that becomes self-evident, we think the dollar will roll over. And we know, again, with some great charts, that uniquely to this cycle, EMFX has outperformed developed market FX. That's rarely the case. When the Fed tightens aggressively, usually emerging markets break. That's not been the case this cycle. It's been the developed markets currencies that have really weakened, but they haven't broken for crisis reasons. They've broken for decent reasons. Euro's down because they've had an energy shock. They need to reprice. The yen is down because the Bank of Japan is not moving off its yield curve control. So you have a blowout in the spreads between yen debt and dollar debt. So naturally, the yen is going to cheapen. Those aren't crises. Those are natural responses to policy decisions. And in EM, which typically is where you blow up, there's no blow up. EMFX is down 4% versus the dollar, versus DM down 12%. And when you look at the dollar today, you look at UUP, which is the ETF expressing the broad dollar index, it's massively overbought, right? The RSI on that earlier this week was over 80.
Wow.
Short-term RSI over 80. Okay, that's not where you want to buy things. That's where you want to sell things. And so we're expecting that dollar to roll over, King dollar to give up its crown, and that should set off some significant asset allocation shifts, both in the commodity space and in the equity space. And so to finish up, Scott, I wrote, and I'll just read it because I'm not going to remember it all. It's not been easy holding a positive view of things this year, this month, or even this week. Yet it doesn't feel like now is the time to hit the sell button and rest easy. Rather, it feels like now is the time to hold the line, stop extrapolating, and start thinking forward. There you go.
Nice way to wrap up, Jay. I like that. Okay, Jay, you have a fantastic weekend. It's like, listen, that was a lot. That was a lot to take in. I like all of it, but these monthly ones always are great.
Thank you.
Good luck with Duke this weekend. I'm not even sure who they're playing this week.
Yeah, UVA at home, 7:30 tomorrow night. Watch it. It's going to be great.
Good luck. Hope you enjoy that. And for everyone else out there, good luck investing.